Welcome to the DIY Investing YouTube channel. We are doing quick dives on the S&P 500 companies. Today is Abbott Laboratories. Don't forget to like this video down there at the bottom and subscribe for more great breakdowns. So let's look at Abbott Laboratories. First up is market cap. We are using quickfs.net. Market cap is at $218 billion. This is a huge large cap company. They're in the healthcare equipment and supplies industry. Pretty attractive industry. The healthcare industry is one of those really high returning industries. They discover, develop, manufacture, and sell healthcare products worldwide, operate in pharmaceutical products, diagnostic products, nutritional products, and medical devices. Now, this is important because some of these are high quality and some of these aren't. When you think about it, diagnostic products, nutritional products, and medical devices are all a very high quality type industries, but pharmaceutical products are less so. Pharmaceutical drugs and such have a lower type of return. There's a lot of R&D there, and they don't necessarily have the same moat as some of these other industry aspects. But generally, I'm immediately thinking this is a high quality company. I want to buy high quality companies, so let's dig in a little further. Next up is beta. I want to buy companies with a beta of less than 1. They tend to be more overlooked, tend to have higher returns I have found at lower volatility. So this is 0.70. That's good. I'm quite interested. Share turnover is 72%. That's pretty high. I'm trying to find some that are below 50%, but it's something that's acceptable. Next, I want to look at return on invested capital. Now, this fluctuates a lot. This is a little more than I want to see. You're in the 15, 17% range. You get down to 8% in 2006, get up to 20%. It's very fluctuating. And you've had years as low as 1%. So this is not as good. This suggests that there's not a huge moat. It's quite a cyclical type company. So I'm getting a different feel than I did before. So let's look at my next area is your 10-year median returns. So return on asset of 5%, that's a little low. Return on equity of 10%, so that's okay. Again, 10 to 20% is the target range, but you're probably getting there with debt. That's the difference between these two numbers. Our 10-year CAGR. These numbers do not look good. Your revenue is basically flat over the last 10 years, and your earnings per share has dropped. Your free cash flow has dropped. Even though you have high gross margins of 55% and decent pre-tax income margins, this is my big concern. This is a company that's not growing, and yet the valuation ratio is 38 on the PE. The EV to EBITDA is 22. Again, PE, you want to see anything less than 15 is something good, 10, 15 or less. This is quite high. At a no-growth company should trade for 8, PE of 8. So maybe the future is going to be different than the past. You're definitely betting on it, though. If the future is anything like the past, you're going to lose money on this stock. EV to EBITDA of 22.5. Again, it's not cheap until it's like 5 or 7, especially if you're not growing. So all these numbers say this is screaming overvaluation, way expensive. So revenue here in 2011 shows 21 million, but 2022 it says 34 million. So I'm immediately thinking that maybe this CAGR number is not calculating properly, because that looks like some pretty substantial growth. Dividends per share have fluctuated a lot. It's not stable. So $1.88, $2, 56 cents, 88 cents, 96 cents. I don't know what's happening here. Something's clearly very different with this company. Let's dive into the balance sheet, see if we can get an idea of what's going on. So assets have grown a little bit over time, but they also shrunk significantly here in 2013. Maybe there was a spinoff or something that could make sense, makes for why something's going wrong that I don't see here. Long-term debt has grown from 12 billion to 18 billion. So they've had to grow their long-term debt by 50%. That's not great, because if we look at the income statement, your net income has not grown by 50%. So you've increased your debt by 50%, but not grown your net income much. Your earnings per share is $3, and it's $3.22. So all I can think is that something happened in 2012, 2013. Maybe there's a stock spinoff or something that changed the makeup of the business. So again, these are 5-minute snap judgments, but initially my snap judgment's not very good here. Your share count is increasing. Your earnings per share is pretty flat, but you're trading at a PE of 38. So I wouldn't be much interested in this company, even though it's high quality. It seems to have very good signs of a high quality business, but you have fluctuating cyclical earnings and returns. You're at a very high valuation. I'd want to buy something that's no revenue growth at like a PE of 8. So what does that mean? I mean, we said earnings per share was like $3. So you're talking about a stock price of $24, $25, maybe $30 per share. And yet your close is at 123. So Abbott appears extremely overvalued. So I hope that's helpful. That's my quick 5-minute look at Abbott Laboratories. Don't forget to subscribe for more great investing videos. We're going through all of the S&P 500. Stick around, like this video. Thank you very much.